Earnings season is underway. So far, out of 136 companies that have reported, earnings over 73% have shown a positive surprise. Let's bring in Sam Stovall, Chief Investment Strategist at Standard & Poor's. He's also the author of the 7 Rules of Wall Street, crash-tested investment strategies that beat the market. He joins us now from his office here in New York. Sam, welcome back to Bottom Line. Always a pleasure to have you on.
Thanks for having me here, Mark.
Sam, investors have had a lot on their plate lately. The earthquake in Japan, the debt crisis in Europe, the unrest in the Arab world, just to name 3. Do the earnings numbers that have come out this week mean that investors have their risk appetite back?
I think they do. Certainly the items that you just mentioned were headline events. You can even throw in the lowering of the outlook of U.S. debt on Monday as a headline event. But I think investors sort of paused, paid attention to those things fairly quickly, but then decided that they would not have a material impact on bottom line events or in particular earnings for this quarter or for future quarters.
And I'm glad you mentioned that outlook on debt, because we're going to get to that a little bit later. But right now, the tech sector leading the S&P 500 higher today following those stellar earnings from Apple and Intel. How strong is sentiment toward technology?
Well, I think what's been happening is that there's been a very big surprise, a big turnaround. When you look at the relative performance of tech versus the market, it had been eroding over the past several months. And I think investors were worried that maybe we would not be seeing good PC growth and just good growth overall. But actually, what's interesting is that both technology and healthcare are the sectors that are showing the greatest upward revision to what we think they will earn eventually in the first quarter.
Sam, other than currency markets, where are investors looking for better interest rate returns?
Well, challenging to find where the better interest rate returns are. I think initially the thought was that we might actually see it here in the U.S., and that's why we were getting a stronger U.S. dollar. But I think in general that the returns from interest rates, you still have to look overseas, and that's the reason why, or one of the reasons why, the dollar is weakening.
Well, the differences between net earnings per share and adjusted earnings per share, historically they're narrowed in S&P 500 companies. Should investors have more confidence about the earnings quality now?
Well, I think when you compare the projections for the GAAP results for 2011 compared with the operating earnings numbers, they are much narrower this year than they traditionally are. And certainly we had a fairly wide gap in 2010 because we still had a lot of companies that were doing a lot of writing down of expenses. So I think what you could say is that the quality of the earnings appear to be improving in this year.
Will the rest of earnings season continue to be this strong, or are today's weaker than expected jobs report numbers going to throw a wrench into things? And secondarily, where is this going to leave the markets?
Well, I think that we're going to end up with about a 15% year-over-year increase in operating earnings for the S&P 500. That estimate is about 1% higher than where it was at the beginning of the quarter. So at least if the early trend will likely to continue, then we probably will be favorably impacted. If you look to the additional quarters, 2nd through 4th of this year, we're looking for fairly similar numbers, actually with a slow and gradual incline. So about 15+% growth for the full year, with about a 16% gain in the 4th quarter.
Well, Sam, as you know, investors were in full retreat on Monday after S&P warned that the U.S. faces a 1 in 3 chance of having its AAA credit rating downgraded. I know that S&P's rating side operates independently of the equity side, but were you shocked by the negative outlook and by how the market reacted to it?
I guess you could say I was shocked but not surprised. Shocked because, well, anything that you're not anticipating sort of takes you by storm. But not surprised when you think about right now our debt is about 65% of GDP, expected to eclipse that important 70% line in the sand as discussed in the book. This time it's different. Right. And so the worry is that we have to get our debt under control. I was a little bit intrigued by the yields actually, the dollar strengthening, yields actually going down. I think the thought is that maybe this will wake up Congress to actually do something, and if that is the case, the Fed might continue to leave a more stimulative monetary policy.
Sam, in our final 30 seconds, do you think other ratings agencies are going to follow S&P's lead regarding the outlook for long-term U.S. debt?
Again, speaking as an investor, not somebody who has any idea what's going on the other side. Basically, I think that if they feel the same way, that they probably would, but most of the street is probably anticipating that they would in some fashion follow suit.
Sam Stovall, Chief Investment Strategist at Standard & Poor's, joining us from his office here in New York. Sam, thanks so much for your time. We appreciate it.
My pleasure, Mark.